Correlation. And what does it have to do with investing? Let's start at the beginning to make sure we understand what it is. A correlation coefficient is the numerical measure between -1 and +1 that indicates a similarity, or difference, in the returns earned by two or more investments. Two investments that move in the same direction will have a positive correlation. The more closely they move in lockstep with one another, the closer they will be to a perfect positive correlation of +1. If investments have a negative correlation, that means the relationship between them is opposite. Investments that have no correlation move independently of one another and have no apparent relationship. In investing, a correlation is a statistical measure that an investor uses to determine just how diversified or not their portfolio is. Meet the Smiths. They work very hard and have built what they assume is a well-diversified investment portfolio. They have primarily invested in 4 mutual funds, and while each of these are reputable and contain well-known, long-standing profitable stocks, it turns out that their portfolio is much more correlated, similar, than they would have liked. To be clear, this is not necessarily a bad thing. It just means that each of their 4 mutual funds, while different, will behave in similar fashion during different market cycles. Knowing this, what might the Smiths want to do? It would be wise for them to sit down with a financial advisor and share their diversification concerns, in addition to maybe recommending that the Smiths consolidate some of their highly correlated investments. Their advisor would likely recommend that they add additional strategies to their portfolio to help lower the overall risk potentially caused by the high correlation of their current investments. To summarize, correlation is the data point that will measure how much or how little the returns of 2 or more investments will move in lockstep with one another. By diversifying your portfolio with investments that have a low correlation to your current investments, you may be able to create a smoother or less volatile ride through the market's ups and downs, which is generally viewed as less risky. Stay tuned as we explain more concepts within managed futures investing.